Chapter 10, we cover fraud and what is going to be management's responsibility versus the auditor's responsibility. So there's different types of fraud, and then we'll talk a little bit individually about both of those, and then we'll get into the auditors who would be responsible again for looking for both of those types of fraud. But we have fraud in financial reporting. So that is a lot of times what we actually hear about in the news, or these companies that get caught and go under. They're more than likely doing the fraudulent financial reporting. So what they're trying to do is manipulate their financial statement numbers so that their stock price goes up. And then ultimately those executives or those people who are doing it make money through the increase of the stock price. So they aren't necessarily like stealing, cash from the company. They're just manipulating earnings to make that stock price go the direction that they want. So either there's earnings management where they make deliberate actions like putting in fictitious revenues, not recording sales sales returns, things like that, so that's going to bump their sales up and make them look like they're doing better. Or they could do income smoothing where they're just going to kind of shift from one income, like one period to another. So say it's the end of the year and they think, oh geez, sales are a little lower than what we predicted them to be or what we expected them to be. So we're going to push some of our January sales back into December, and then we'll just true it up next year. Or we're going to throw some of those expenses, maybe there's some big like attorney fees or a class action suit that they know is coming against them, instead of recording it when they realize it, push it out until the next period. So some of those are a little harder to find because they do involve judgment of management. But all those kind of go into that fraudulent financial reporting. Misappropriation of assets is actually stealing. So the thing is, I feel like normally it's like our lower level employees. I mean, high level employees can steal as well, but a lot of times if they're stealing inventory or stealing cash, it's a lower level person and then a smaller amount. So sometimes those frauds aren't even material to the financial statements. So here's the conditions for fraud. It's called that fraud triangle, which you've probably had in other courses, but there's an incentive for you to steal or a financial pressure. So let's say you've got a personal financial problem. Maybe you're going through a divorce. Maybe you have a bad gambling habit and you're in debt due to gambling losses. Whatever. There's something that's kind of making you think, oh gosh, I could use that extra money. Then you really though have to see an opportunity where you could do it, to think, ooh, the internal control procedures are pretty weak here. I see that I could set up a fake employee. If I'm working in the payroll department, who's going to catch it? Or maybe I work in accounts payable and I can set up a fictitious vendor, and no one's going to catch me doing that. And then I'll just cut myself a check every Friday. So you have to somehow see where there's an opportunity for you to do it. And then you rationalize it. So a lot of times, like say you have managers who are kind of doing some shady things. Maybe they're manipulating earnings at the top. And so you're thinking, well, they're not even ethical. Or you could think, well, gosh, I worked so hard and I didn't get my bonus this year, so they owe me. There's different ways that people work through it. Or maybe it's even thinking, well, I'll borrow the money. Maybe I have access to the petty cash box and I'm slowly, taking money out every week. I'll pay that back later. So those are kind of some rationalizations to fraud. So when it's fraudulent financial reporting, though, it's a little bit different. So it's not like that employee who's taken money out of the petty cash box. This is, to me, more higher level people. It's going to be your executives, like your CFO, your controller, those kind of people who are up there. So they feel the pressure. They feel the pressure from the executive, like the president. So when I worked at the oil and gas company, our president was always concerned about what was happening to that stock price. So if all of a sudden the stock price is going down for whatever reason, all of those vice presidents, the executive level people, are going to feel that pressure. Like, shoot, public expectations were that we were going to do better. We set these targets that we told the financial community about, and we're not living up to them. So then all of a sudden everybody's feeling that pressure to get earnings up or to reduce expenses or whatever you need to meet those targets that you had initially set. So then you look for, well, where's my opportunity? Again, you're a high level executive type person. It's really going to be in like where you make estimates or judgments, and then you could get away with it. So say again, you're the CFO and you're estimating, like some sort of expenses for that season, or estimating, maybe your revenues can be, maybe you have some revenue accrual adjustments that you can make. So, I mean, again, you got to kind of see where could I do it. But a lot of times the estimates or the judgments could be used because the auditors can't quite track those directly. So then the rationalization is always that we'll true it up next year. You know what I mean? We'll reverse it when our sales go up. We'll slowly charge it off over time. Again, you just want to, they're all just trying to live up to those financial analysts' opinions. So if they know there's a place that they can then correct it, that's what they'll do. Because it's not necessarily like anyone's taking any money. They're just manipulating the earnings to match what the financial community is expecting so that the stock price does not go down. So then when you assess, so now we're flipping back over to, okay, we're the auditor. So then what do we need to do to assess this risk of fraud? So we have to use that professional skepticism or that questioning mindset, and then evaluate the evidence to say, does anything look off? If we start to say we're doing some analytical procedures and we think, gee, revenue looks a little different or gross profit looks a little odd, then you want to gather more evidence to take it down to the next step. Maybe then start taking those sales and tracing those to shipping documents so you can clearly see that the inventory has actually shipped, things like that. So sources obviously comes from communication with not only the audit team, but the management of the company. A lot of times that's our main source of communication. Consider risk factors within the industry, and then always run analytical procedures. So again, comparing numbers from this year to last year, comparing numbers to competitors in the industry or percentages to the competitors in the industry, just to see if anything jumps out. There's any unusual activities. But like as this last bullet point says, normally the auditors are not going to be the ones that uncover the fraud. It's the people who work in that business day in and day out. Those are the people who really are going to be able to uncover fraud or know that there's a chance of it. So management, internal companies management definitely can reduce the risk of fraud if they can maintain an ethical culture. So if they've got a code of conduct or an ethical codes that they maintain, if their tone at the top is honesty and integrity, obviously that sets it. I mean, because you can be a lower level worker and come in with a great attitude and great values, but sometimes it's like that drippy faucet. Over time, if your people above you are constantly, doing stuff a little bit unethical, cutting corners here, doing things that they shouldn't be doing, and you see it all the time, it does start to kind of wear on you. But also hiring competent, honest, employees who do have good work ethic is going to help. Again, keeping the tone at the top high, hiring good people, and then disciplining workers when you do see anything that is not ethical going on or any issues. Because that's the other thing that can really create a bad work environment is when one employee sees another employee doing something questionable and not getting disciplined for it. The management has to develop internal control procedures to try to level those risks in all the different areas, whether it's receivables or inventory or setting up vendors or payroll. All those things should be looked at to say, well, where can fraud happen, and then what can we do to prevent it? And then they should then go back after they set these controls in place, actually monitor that they are being followed and that they are hopefully preventing fraud from happening. They can use an audit committee or even an outside independent third-party committee. But an audit committee would be a deterrent of fraud because they're going to have direct reporting to the auditors as well as to like the board of directors. And they should have reports of any whistleblowing that's happened within that company, any suspected fraud, and kind of what happened there. Sometimes with those third parties, you can have a like a 1-800 or a toll-free number that the people don't even have to identify who they are. But if they suspect fraud in that company, they can call that toll-free number and just say what they're thinking, and it'll be checked into. Now, the auditor's response. So that was kind of the management's responsibility. Now, again, we're flipping back to we're the auditor. So if we as the auditor think that there is a risk of fraud, we're going to want to change our overall conduct of the audit. So it may have to be, if there's anything unpredictable in there, it's going to have to be different. A lot of times what auditors do is they just copy prior year's standards to say, oh, nothing's changed, let's just do it the same as last year. So if we're going to have to, if we're thinking there's fraud, we want to be a little bit more predictable and switch it up. So not do the same as last year. So the management isn't going to just know exactly what we're doing. Perform audit procedures that would address those fraud risks. So again, where do we see the fraud risks? Is it in revenue? Is it in accounts payable? Is it in inventory management? And address how we are going to audit those specific areas. And then perform procedures that review the potential management's overriding capabilities. So that's talking about, again, because like I said, the financial fraud a lot of times is going to be at that higher level. So it's probably not going to be like in a vendor invoice or in a sales invoice. It's going to be more in unusual items. So adjusting entries that are done at the end of the quarter could be looked at. Any estimates made by management should then be traced through, trying to understand how they came up with those things. Maybe use a third party to validate or to value it to make sure it seems accurate. And then, of course, understand the rationale that the business is doing. Then as they're doing their audit, if they uncover any fraud or thoughts of fraud, they're going to have to adjust it as they go along. So it's not like you only do it at your planning stage. It's going to need to be assessed throughout the audit. So then we get into specific fraud areas when we're actually inside the audit and we're looking at our different accounts. So in our revenue accounts receivable cycle, that's probably the biggest one that could be manipulated. And again, because it is dealing with revenues, which obviously all companies want to have higher revenues. And then, of course, that hopefully leads to higher net income. So that's an area that we definitely want to look at. But they could be recording fictitious revenues, which would just mean they're making false invoices that really aren't going to be as easy to be traced to supporting documentation. They could do premature revenue recognition, where they call it bill and hold, where we bill the customers ahead of time, but we hold the goods until later. So normally you don't bill out a customer until the goods ship, but if it's a specific type of a contract, you could do that. So they may create some of those just so they can have the sales in the current period. Or some companies have been known to ship out a bunch of goods to their existing customers. So say like, Walmart's your customer, you're going to stock them up, send them a whole bunch of goods, but then give them the right to return it within 30 days if not sold or something like that. So you're kind of like stuffing your suppliers with your product. That way you've got sales. They could return it next period, but you'll deal with that next period. Manipulation of adjustments. So maybe they don't record all their sales returns. All of a sudden goods come back, but they don't make it as a contra revenue account. And then now they're just valuing it in inventory again. So you're almost like doubling, you're doubling your inventory and leaving it in sales. Or maybe manipulating your bad debt. So you might know you have some bad debt out there, but kind of adjust some invoice dates, make things look like it's not over 90 days on the aging, and just kind of keep it through, again, just for this year. These things aren't like permanent fixes, but you could just get those revenues in the current year. And then theft of actual cash receipts, which again I always feel like is more immaterial, but that can happen. People could people who work in that department could take advantage and somehow confiscate those cash receipts and cash them, and then just kind of float it so it doesn't, apply it to the next invoice, so that even the people that you're, taking it from aren't completely sure that they haven't gotten credit on that payment. Inventory is not as many areas to do that. They could increase their assets by creating fictitious inventory, again, just to impact the financial statements, or there could be theft of inventory, especially say it's a retailer or something that your employees could be stealing, or they could allow for, people they know to come in and steal after hours or things like that. But those, again, are normally not super material. Accounts payable fraud would be paying a fictitious vendor, so setting up vendors that don't exist and making payments to them, which would be, again, a misappropriation or stealing of the assets. Accounts payable fraud from a financial statement standpoint would be not recording it in the proper period. So maybe you get a bunch of invoices in December, you want your net income to be higher, so you stick them all in a drawer and pretend like they don't come in until January, and you don't accrue them, and they don't get entered into that till that next period. Fixed assets would be setting up fictitious assets or capitalizing costs that really should have been like expensed as incurred. They really didn't add future service life to the asset, but again, maybe it was a major repair and we're going to capitalize it, so that, again, it reduces our expenses. Maybe there's subjective values assigned to the intangible assets. Auditors could always have a third party come in to evaluate some of those if they were super material. And then payroll is, again, normally not material. You could set up fictitious employees, or an employee could be padding their hours to say, hey, I worked more than I did. But again, normally that doesn't amount to a ton of money. And when I'm looking at my PowerPoint, sorry, that should go 1, 2, and then these should be 3, 4, and 5. My numbers got. Okay, then responsibility for fraud. So if you look, the textbook gives us a little table of that, but you can see that by far the most common way that fraud is uncovered is through an anonymous tip. So somebody calls that hotline and says, hey, I work there and I know this is going on, but I don't want them to know who I am. So if they get those tips, then they obviously have to go in and start gathering some additional information and doing some inquiries. So it could be informational, where you're just asking open-ended questions to the different personnel who are performing their jobs. You could take it one step further to do an assessment, where you're asking for some actual backup information that you could trace. So maybe like you're going to just have some invoices and then trace those to the shipping documents. Or it could be more interrogative, where you're asking confrontational direct questions, maybe calling in people, into the office of the, management or the audit committee, and really kind of get to the bottom of some of those things. So if it's the auditor doing the questioning, they've got to evaluate the inquiry. So always use that questioning mindset, but listen for any verbal or nonverbal clues that they might be giving you. And again, just you want to not completely trust the people. You want to exercise, again, a little bit of skepticism to think, does that seem reasonable? Do they seem nervous? Is there anything going on behind the scenes? And then always use data analytics. The auditors normally have software programs that go in, or again, Excel manipulation techniques, where you go in and you look for duplicate invoice, you look for sales that are missing invoice numbers, you look for sales amounts that are, maybe all their sales amounts always have dollars and cents, and then all of a sudden there's one in there for $5,000 even. Well, what's that? You know what I mean? That doesn't seem normal. Maybe if it's to the point where you're matching it to like shipping documentations, search for anything that has an invoice but no matching shipping documentation. And those are some of the things that we're doing in our assignments in Excel to kind of search for some of those things, because those are things that the auditors do during their data analytics. And the final step is documenting it. So the auditors need to document the discussion that they initially have as an engagement team that is assessing the risk during their planning phase. Then they need to document any procedures that they performed to identify the risks of material fraud, any specific risks that were identified during the audit, and then how did they respond to those risks, the results of their tests of their procedures. So these are the internal control procedures, especially focused on how can management actually override those. So again, not like your lower level people, but how could like the CFO or the controller come in and override those? And then if there's a chance of that, how are we going back and testing those procedures to make sure that it isn't happening? And then any other actions that were taken and or communicated with management during that audit should all be documented.